What's up, everyone? It's Scotty with MoneyVest. Today is inflation day, so CPI numbers are coming out in less than 30 minutes here. So at 8:30 a.m. Eastern, we've got CPI. If you guys can see me and hear me, just give me a thumbs up in the chat. I just want to make sure that the audio and the video is working well. Milan, thank you so much for joining. Mihail, Tilak, Akash, Nas, Roshan, thank you so much, everyone. Shout out to all of you. So again, audio and video is good. Just give me a thumbs up in the live chat. And we've also got the poll going on for core CPI. We got lots to unpack and lots to discuss. Make sure that you also smash the like button as you are coming in so this stream can get the recognition it deserves and, of course, getting pushed out to more and more people. We are ready and we are excited for the inflation numbers for the month of May. So get ready. And, of course, not to mention the FOMC meeting. Later today at 2 p.m. Eastern, we've got this statement, the summary of economic projections. For that, I will also be live and will also be listening in to the Jerome Powell's speech and, of course, the FOMC press conference as well. So thank you so much for joining, everyone. Ricardo, Kevin, shout out to all of you guys. This right here is going to be the market. So we got the QQQs slightly down right now, pre-market coming down, but still up over 16 basis points. We got the SPY up about 15 basis points, and the Dow Jones here up about 10 basis points, with the 10-year treasuries sitting at just under 4.4%. The consensus for today, 0.1% month over month for CPI. That's your headline CPI. Year over year sitting at 3.4, unchanged, slightly basically intact from last month's number. And then we got X food and energy. So once you take food and energy out, because they are a little bit more volatile, 0.3% is going to be that month over month number for core CPI. And then core CPI year over year, this is the most important number of them all. 3.5% is going to be that consensus for the month of May, and that's going to be slightly down from 3.6%. So the poll right now that we have is going to be, is core CPI going to be above, below, or at 3.5%? So right now, we got a very, very tight battle, 39% below 3.5%, 32% at 3.5%, and 29% of people or investors expecting CPI, core CPI, to be above 3.5%. This right here is going to be Goldman Sachs expectations for core month over month. So this is the S&P 500's reaction based on the different values that we may get for core inflation. So if it's less than 0.2% month over month, S&P can be up over 1.5%. Is there what they're expecting? Because right now the expectations are for 0.3%. So of course 0.2% or lower would be very bullish because it's a less increase on a month over month basis. If it's 0.2 and 0.25%, then we're expecting for the S&P to be up 0.65% according to Goldman Sachs. If it's between 0.26 and 0.3%, then the market's to be plus minus 0.3%, so basically flat. And if it's over 0.3%, between 0.31 and 0.34, the markets can be down 0.75%. And if it's over 0.35 and 39, down 1.5%. And if it's anything over 0.39, almost 0.4% or higher, then Goldman's expecting for the markets, the S&P 500, to be down over 2.2%. On the day. So again, these are the S&P 500 expectations, reactions from Goldman Sachs, which, take it with a grain of salt because nobody really knows where the market's going to go, what the markets are going to do. But yes, you can kind of get an idea that, okay, if it's higher than consensus, if inflation increases month over month by more than what the expectations are, of course, the market's going to take that as a negative catalyst and go down. And the opposite is also going to be true. If it's up by not as much as what the market's expecting, then of course that's going to be very bullish for the market as well. This is from JP Morgan, so not from Goldman, but JP Morgan now maps out the game plan on CPI day, and the bank's trading desk offers a scenario analysis for the US stock market. Below 0.2%, market gains 1.75 to 2.5%, between 0.2 and 0.25% increase month over month for CPI, and they're actually giving us a headline CPI reading, not a core reading. Which they assign a 12.5% probability to, gains 1.25 to 1.75%, and between 0.25 and 0.3%, they're expecting 25% probability. Market gains between 75 basis points to as much as 1.25%, and the most probable outcome, according to JP Morgan, which is a 40% probability here, that CPI month over month increases by 0.3 to as much as 0.35%, and that is going to result in the markets to basically be flat, down 75 basis points to as much as up 75 basis points. So that's about 150 basis point up or down in that basically that range for the S&P 500. And then between 0.35 and 0.4, markets down 1 and 1.25%, and above 0.4%. Markets down 1.5 to as much as 2.5%. TM Knight says, would be so funny if the opposite happens for the markets. And that's what happens, right? When everyone's expecting one thing, the exact opposite ends up happening for the markets here. So B of A also suggesting that history doesn't repeat itself, but it rhymes, even inflation history. And this is US CPI, between 1967 to 1985, and from 2014 to present. And of course, we have seen very, very similar trends in inflation. And right now, of course, we have been coming down, but really just, trading sideways. We've just been consolidating in that range. So, of course, it's possible that, inflation starts reaccelerating back higher, which obviously would not be good news for not only the markets, but for the Federal Reserve, for unemployment, for the economy. Again, we'll have to sort of revisit, what the strategy needs to be. The Federal Reserve would need to revisit what the strategy needs to be. But right now, again, it is still below 4%. And these are the expectations from different banks for headline CPI and for core CPI for month over month and for year over year. Bank of America, 0.13, 3.4%, and for core 0.3 and 3.6. So that is, the most pessimistic banks are Bank of America. We got BNB Paribas, and we got Nomura. And then everybody else is expecting for core CPI to be at 3.5%. So of course, if it's below 3.5, which 32% here, people are actually 38%. Majority right now of you are expecting for CPI to be below, core CPI to be below 3.5%. That is actually going to be very bullish for the market. So that could lead to, of course, a very significant move to the upside for the markets here if core CPI ends up below 3.5%. So big day. 16 more minutes left for us to take a look at those inflation numbers. Make sure that you are dropping a like and, of course, subscribing to the channel. Do share this live stream. Do me a favor, share this live stream with everyone, your friends, family, neighbors, every single person who wants to join. Of course, take a look at the market's reaction and the inflation numbers as well. And then, of course, we'll also go over the detailed analysis of where the increases are, what's causing inflation to be where it is, and then take a look at the market's reaction for interest rates and how that changes. Because right now, the markets are once again back to repricing 2 rate cuts in 2024, starting in September, and then the second rate cut happening in December, and then one more in 2025 in March of 2025. And also, don't forget, we've got the meeting today. So June 12th is when the meeting ends, and we're going to have the press conference, Jerome Powell's speech, as well as the summary of economic projections. And the most important piece of this summary of economic projections is going to be what? I mentioned this in our yesterday's market update, but what is going to be the most important piece of information here in the SCP? There are 3 things that are important on the day today. So today, June 12th, there are 3 things that we're paying very close attention to. What are those 3 things? What are those 3 things? I want to know in the live chat if you've been paying attention, if you've been watching videos, what are the 3 things that we are paying most attention to on the day today, on June 12th? What specifically are the 3 things? We already know that that inflation numbers are coming out. We already know the Federal Reserve is going to be releasing their statement, their SCP, their speech. But what are the 3 things specifically that we're focusing on for the day, which are going to be impacting the markets the most? The 3 key metrics. The third one may not be a metric, but really, what are the 3 things that we talked about in our yesterday's market update? I mentioned this in our market update from yesterday, that these 3 things are really going to be dictating where the markets go. So again, thank you so much for joining, everyone. Really appreciate it. In a little bit, we're going to do a quick shout out to everybody from all over the world, wherever you guys are watching from. So we're going to do that as well. TM Nice says unemployment, CPI, and another one. So unemployment is not coming out today. So unemployment came out last Friday. We already broke that down. We already did a video on that. So unemployment is not coming out. CPI, you're close. And another one, of course, there's total 3 things, very important 3 things that are going to be very important for the day today, right? So that's basically what's going to dictate where the markets go and what the market's reaction looks like. So let me see who's got it. We've got over 100. Well, I've got over 200 people watching now. So let me see who has the exact answer for the 3 things that we are watching on the day today, the markets are going to be paying attention to the most on the day. So Sean says Tesla shareholder vote. So that again is going to be on Thursday, June 13th. So that is scheduled for tomorrow. Our shareholder meeting, I should say. I already voted, but tomorrow we've got the shareholder meeting, and we're going to learn more about, of course, which way is the vote going to go for. But that is for tomorrow. We're talking about today, June 12th, the three most important things that we're going to be paying attention to, because the market's very, very important stuff that's going to be due from today. So let me know in the live chat. I want to hear from each and every one of you. We've got over 200 people watching. I'm sure someone out there is going to have the answers. So Kevin says dot plot. So yes, so that's one of them. Because that is the interest rate expectations from FOMC members. So that's going to be this right here. So you see the federal funds rate over here. One of the three most important metrics to watch for the day today, because that's the Federal Reserve's expectations for interest rates. In the previous meeting, it was 4.6%. If this number goes higher or lower, very, very important. I cannot stress how important that is, because that literally is the Federal Reserve's expectations, is what they're penciling in, and the dot plot is essentially going to represent that. So yes, number one, dot plot, but that comes after. Before that, what do we have? So Parade says rate cuts, GDP growth, and dot plot. So again, close, but not the exact answer. So Iceman says inflation. Yes, so what exactly in inflation? What exactly in CPI are we focusing on? So Dev says CPI, rate cuts, and housing. Very interesting. So again, not that I know of a lot of housing sort of data points coming out today. So yeah, we got 4-month bill auction. We got the Federal Reserve Chairman Jerome Powell's speech. How to be able to vote for a Tesla meeting. So you should be able to vote through your brokerage. So your brokerage should have sent you an email saying that Tesla vote is coming up. You can go to a proxy vote and you can send in your vote there. But your brokerage should have sent you an email, suggesting for. Okay, so rentals. Well, more specifically, it's going to be core CPI, right? So the three most important metrics I'm going to mention is the dot plot, which Kevin mentioned, which is the interest rates expectations from the Federal Reserve. More importantly, in about 11 minutes, we're going to mostly focus on the core CPI number. That's the read, which is market's preferred measure of inflation, Federal Reserve's preferred measure of inflation. And the third one is going to be Jerome Powell's tone, the speech itself, right? So those three things are the market moving metrics, as I like to call them, because nobody really cares about headline CPI all that much, or month over month change. People mostly care about core CPI. That's number one. Number two, SEP, summary of economic projections. Nobody really cares that much about inflation expectations or GDP expectations or unemployment expectations, because those are, at the end of the day, only expectations, and the Federal Reserve themselves don't really know where all those things are going. What they control is really interest rates, and interest rate expectations are what they're penciling in, and that's going to be the second thing. And third, of course, is Jerome Powell's tone, speech itself, whether he's sounding hawkish, whether he's sounding more dovish, and those three things is where all eyes and ears are going to be, and the most market-moving events or data points for the markets here. Okay, when is the meeting? So meeting's at around 2:30 p.m. Eastern, so I will be live to cover that as well. And the yields, so yields will get affected. And the tie color, yes, that's the fourth and the bonus metric to focus on is the tie color from Jerome Powell. But yeah, yields, we'll take a look on how the yields react to the inflation numbers in about 9 minutes. But we got about 190 votes. We're trying to get to at least 500 votes here. So make sure that you do participate in the poll. We've got about 9 more minutes until CPI numbers come out. So make sure that you are participating in the poll here. Are you expecting above, below, or at 3.5% for core CPI? So I want to see at least up to 300 votes here in the next 5-6 minutes prior to the numbers coming out. So do that, participate, cast in your vote. Let us know what you are expecting for core CPI. And markets pre-market are more or less flat, kind of waiting for this number here. Apple had a insane day yesterday, up over 7%. Bass got here on just in time. How are you doing? So doing well. Thank you for asking. Just been gearing up and preparing for the platform launch. So this right here is going to be the platform, and we've added a new feature. Basically, you'll be able to kind of plot the MoneyVest metrics. So whether it's revenue, whether it's gross profit, net income, you can really start to visualize how the company is doing in terms of its overall trend analysis. And you can also, on top of that, include some margins, gross margins, net margins. Let's say efficiency, you want to evaluate CapEx as a percentage of revenue, and also, different metrics such as gross margin, net margins, and then also valuation. One of my favorite ways to kind of analyze this is overall valuation for a given stock. So if I look at the price to earnings multiple, the price of sales, the price of free cash flow, then it really helps me better understand what's the overall valuation and how that's changed over a time period of 7, 10, 3, 5 years. And this is Apple, for example. You can see how it was obviously trading at a much lower multiple, then of course spiked up starting 2020, and since then it's been relatively higher, at 30 times cash flow, over 30 times earnings, and a little bit over 7, almost 8 times sales as well. Of course, you can do the same thing with fundamental analysis and the stock analyzer tools as well. So yeah, just been occupied with that. But volatility is at an all-time low. I think it's time we see a big move down. So VIX is at around 13, so near 5-year lows here. So we continue to see VIX at a really low level. So if we get any type of data point that is not favorable for the markets, wouldn't be surprised to see volatility higher, and the markets, of course, seeing a bit of a small dip or a correction as well. Trueflation indicates a significant drop. Not sure how reliable it is versus official numbers, though. Martin says, what is the use of the poll and the numbers of the market always goes up and up? So that's what's happening now, right? But that's not always the case. Of course, the market is not going to go up forever. Ask anybody who's lived through the 2022 bear market, the 2020 crash, or 2007, 2008, or the 2000 bubble, or 1980s. The longer you are in the market, the wiser you become, right? The longer you've been investing in the markets, the more experienced you become to understand that markets don't go up forever, neither do markets go down forever, right? It's just a cycle, and pendulums swing on from one extreme to the other. Of course, we can jokingly say that stocks only go up, because if you do zoom out and if you look at the grand scheme of things, yes, stocks have historically just gone up, because over a 100-year time period, we're hitting a new all-time high. So yes, markets do go up far more often than they go down. But to say that markets only go up, obviously, is incorrect, right? Markets do go into 2 years bear markets and don't do anything. So we have to just be aware of those situations as well. Okay, 5 more minutes left, folks. 5 more minutes. We are up to 250 votes. Just a few more, and we're going to hit our target, so make sure that you do participate. Just watch Powell. What do you predict for the report? So I do think that we're going to see some progress on oil. It's possible that we do see some progress on, crude oil, energy prices, but on other factors such as rentals or shelter, it's possible that we do see a slight increase once again on a month-over-month basis. What did you vote on the poll? I voted at 3.5%, so at around 32% people expecting for core CPI to be at 3.5. Is the last FOMC meeting before the elections? It's a great question. I don't think so, but let's take a look. So we've got... we got another FOMC. We got actually a couple more FOMC meetings before the election. So July 30th, 31st, September 17th, September 18th, and then November 6th, 7th is when we have the meeting for the FOMC. November 7th, literally on my birthday, I will be streaming the FOMC meeting on that day, because November 7th is when the second day is for the FOMC meeting. And we'll be live, of course, to cover that. And December 17th, 18th is going to be the last and final meeting of 2024 with the Summary of Economic Projections. We're kind of halfway through for FOMC meetings, because we've had 3 done. And then after today, we're going to have 4 meetings done and then 4 left. So we'll kind of be at the halfway mark for FOMC meeting. And then 2 more with SEPs and 4 more in total left for 2024. Anyway, so we're going to do an audio check for everyone. Make sure that you have the audio and the video working well. Again, thank you so much for joining, everyone. Just do me a quick favor. Shout out to everyone and where you're joining from. So let me know in the live chat, where exactly are you tuning in from? We got 2 to 3 more minutes left for live stream for the inflation numbers to come out. So let me know in the live chat, where exactly are you joining us from? And I'll start Dubai. is where I'm at. Let me know where you guys are joining from. What part of the world are you tuning in this morning or this afternoon or this evening to watch the inflation numbers with us? So let me know in the live chat. I want to see a lot of numbers pop up and a lot of places, a lot of amazing places pop up. So let me know, and we're just getting ready here to get started. So again, thank you so much, everyone. Shout out to Netherlands, Houston, Taiwan, Montreal, San Francisco. We got Texas in the house, Frankfurt, Taiwan again, Arizona, United States. Shout out to Singapore, Ohio, California, Thailand, Dubai. Yogesh, that's great. We should connect if you're in my area. Romania, we got Italy, Switzerland, St. Lucia. We got Virginia, Sweden, Toronto, Poland. Wow, we got lots of people joining from Europe. That's incredible. And then, of course, we got lots of people joining from Texas, Florida, Northern California. California, of course, being a top place. You got Calgary, Michigan, Barcelona, New York, Charleston, Scotland, Italy, Illinois. Perfect. Transmission received in New York, Kuwait, Canada, Switzerland. Again, thank you so much, you guys, for joining in. Really appreciate each and every one of you. And we are just about getting ready for CPI, May 2024 CPI, and very much of a market moving event. So we'll break down exactly where inflation's coming from, what part of inflation. We'll take a look at some individual indexes related to when you strip some things out of inflation, what's the year-over-year read, and then we'll take a look at the market's reaction. Quick read on the S&P 500 index, in other words, the MoneyVest index, which is correlated with the S&P 500. We're at 3.66. So we're still pretty elevated. I would say we're still in the red zone. So the risk reward continues to not be super favorable in the markets at the moment. All right, you guys ready? How are we doing on the votes? We got 310 votes now. Perfect. Drop a like if you are just joining in. I would really appreciate that. And we have got about a minute left for CPI numbers. So let's do this.
We are just moments away from the release of the May Consumer Price Index. When I introduce our panel this morning, Wendy Edelberg is an Economic Studies Senior Fellow at the Brookings Institution. Veronique DeRougy is a Senior Research Fellow at the Mercatus Center, and our very own Steve Leisman and Rick Santelli are back as well. Right now, the futures ahead of this have been in the green, but just barely all morning. Dow futures up by about 25, the S&P up by 6.5, the NASDAQ up by 28. The expectations are for a headline number month over month up 0.1%, the core month over month 0.3%. Headline for year over year up 3.4%, and the core year over year up 3.5%. Ahead of this, you can see the Treasury market with the U.S. 10-year sitting just below 4.4%, 339. The 2-year is sitting at 483. All right, we want to get right over to Rick Santelli. He is going to have those numbers in just about 5 seconds' time. Rick.
May read on the Consumer Price Index. And of course, this is expected to be a big deal for the Fed, which meets today, by the way, and it is hitting the wires. Unchanged on headline month over month CPI, unchanged. As was pointed out, we're expecting up 0.1%. Unchanged is the lowest level going all the way back to May of 2020, so we'll call it 4 years when it was minus 1/10. We've had several reads that have been zero. Now, if we look at ex-food and energy month over month, up 0.2, also, as Becky pointed out, 1/10 lighter than expectations, 1/10 lighter than the rear view mirror, up 0.2. Last time we were at 0.2, well, it was October of last year. To find a lower number, up 1/10, you're going to August of 2021. Now, the year-over-year numbers, 3.3 on year-over-year headline, 1/10 lighter than both expectations and the rear view mirror. 3.3 is the lightest going back to February when it was 3.2. We started the year at 3.1. And finally, ex-food and energy, or core, year-over-year, expected 3.5. Last look, 3.6, comes in at 3.4. 3.4 is the lightest level going back to, and this is a long way, we're going all the way back basically 3 years to April of 21 when it was 3.0. Even last month's 3.6 comp to April of 2021 because there's a real void there by the way it shot up so aggressively post-COVID. Now, Becky didn't give you expectations for the indices. I consider them maybe the most important. On headline, non-seasonally adjusted, the actual index, it moved up to 314.069, a new all-time high. If we look at the core index, which is seasonally adjusted, that moved to 318.14. Guess what? A new all-time high. Those indices have never been higher, and they underscore the angst that the population has, because no matter how small the month-over changes get, the cumulative effect is substantial, and that's what these indices continue to show us on a month-over-month basis. Yields, as expected, have dropped rather dramatically, and now we're getting right back into where the area of trade was before the non-farm numbers were released last Friday. We're hovering right around 427, 428. That was the low yield before we skyrocketed on the jobs report. The short end of the market dropping as well. We're now at 468, as Becky pointed out. We're at 483-ish before the number. Substantial drops. Pre-opening equities have moved all the way up 260 points in the Dow futures. Becky, back to you.
Rick, I think you summarized it so well. And your point is this basically erases the jobs number that showed maybe something that wasn't going to bring us rate cuts. This erases that number and kind of evens the table again, the playing field?
Yes, I would think that's exactly right.
Wow. Okay, these are some really big moves. Let's get right over to Steve Leisman. He's been digging through these numbers too and can join us with more on why we got these numbers. Right? Steve, what was the issue?
Yeah, first, topically, score one for the Doves here. We were trying to, it was kind of like a contest here between the disappointing first quarter and the great progress of last year on bringing down inflation. The question was, did the first quarter augur a beginning of a new higher inflation cycle? April and May together seem to suggest that was not the case. And this debate over whether or not it was renewed inflation or this issue of sort of beginning of the year price increases seems to be, or at least being settled now in terms of continued progress on inflation. Food was 0.1, energy minus 2% with a 3.6% decline in gasoline. New vehicles, a pretty big drop at minus 0.5. Used cars, however, going the other way, up 0.6. That was interesting there. Surge in medical commodities up 1.3. And we did this number, importantly, without a whole lot of help from housing. Owner's equivalent rent still at 0.4, not reflecting any of the change at all that people think is happening, though I will point out Diana Olick, I guess it was yesterday, reporting a renewed increase in rents. But again, that motor vehicle insurance number, remember it surged 1.8%? This was thought to be catch-up from higher auto prices leading to higher insurance prices. Well, that was down 0.1, and airline fares, to renew an old debate between Joe and Andrew, down 3.6%. So there's a lot of, as Rick said, zeros and negatives in here, and you get the impression that what you saw in the beginning of this year, Becky, was beginning of the year one-time adjustments. This is not tremendous progress. It's going to give the Fed confidence to cut, but at least puts us back on the road. And I'll give you right now, I'll look it up, the probabilities now, which I'm guessing are a bit higher. 54 was the number for September, and now it's 69. So you've gone from a coin flip to a little bit more confidence now in a September rate cut, and 82% for November. Let me see what the year-end number did. The January 2025 contract, we've gone from basically thinking of 1.8 cuts to 2.2 cuts, which means we kind of restored the second cut here. Not a dramatic move in Fed fund futures, but again, a little more confidence that the end of the year could bring us rate cuts.
I've been saying this for 24 hours. I flip-flopped just in time, Steve. It was yesterday. Remember?
It was yesterday.
It was yesterday.
Joe, as long as you...
I've been saying this for 24 hours.
as long as you gave people a heads up to make the trade, Joe, you're good. That's all that matters.
Who talked me into it yesterday?
I did.
I think you did, and
Steve can take some credit. Yeah,
Somebody else.
No, somebody talked me into that it's inflation. David Malpass.
All right, folks, huge print here. So I think beats on all four accounts here, which is, one of the best reports anyone can really get for inflation, because no change in month-over-month inflation, so 0.0% year-over-year for CPI, so headline coming in at 3.3%, and core inflation, which is really where our focus is, where the market's focus is going to be, month-over-month 0.2%, so a much smaller increase compared to what many expectations were at 0.3%, and year-over-year core inflation sitting now at 3.4%. So if you come over to the BLS website, if you go over to, again, this is the actual report. So, we talked about how energy prices were lower in the month of May. So that, again, contributing a significant portion to inflation coming down, because we did see 3.6% decline in gasoline, 3.5% decline in energy commodities, and overall energy was down over 2%. And then we had apparel prices down 0.3%, new vehicle prices down 0.5%, transportation services on the back of energy prices down about 0.5% as well. So energy, again, playing a significant role, because if you come over to crude oil, if you come over to the month of May, you can see that, again, prices were down in the month of May, down over 5.3%, which is exactly what we talked about in our yesterday's market update. However, in the month of June, they are now once again bouncing right back up a little bit over 2.3%. Now, if you come over to the actual index itself, I don't know why it's not loading up, but the index itself hits a new all-time high. In other words, the consumer price index for total goods and services. So if I zoom in, maybe I can see the May report here. So right now it's still showing for April, but this index also hitting a new all-time high. So as we have discussed before, that it's not so much about the year-over-year change, it's really about the consumer price index. The index level is hitting a new all-time high. So yes, the change is coming down. In other words, the year-over-year increase is less than what we have seen before. The prices are still obviously higher compared to where they were a year ago, 2 years ago, 5 years ago. So we're still hitting a new all-time high for the index itself. If you come over to the charts, this is the number for index, consumer price index here. So CPI, once again, coming down to 3.3, but we're still above the 3% level from back in June of last year. So we've really just been consolidating in this 3 to as much as 3.7% range for a really long time. And then, of course, if you come over to core inflation, so all items as food and energy, that is trending lower at a much faster pace again. So 3.8 down to 3.6, now 3.4 in May of 2024. So very, very strong number coming in. And, of course, the market's reacting very positively with the NASDAQ up almost 1%. Got the S&P up over 77 basis points. NVIDIA here hitting a new all-time high to 122, up over 1.5%. Apple here, after a very strong day yesterday, is basically flat. Amazon is up 68 basis points. Tesla is also up about 83 basis points on the day so far. And the yields, of course, dropping back down to under 4.3%. So overall, very strong numbers. And if you take a look at the market's reaction to interest rates, we're now looking at let's see if you go to probabilities. This is going to take some time to update, but now it's starting to, again, September cut, then we got a December cut, and then another March cut of 2025. But this, of course, is going to change and shift in a little bit as the market starts to digest the numbers here that we're getting for inflation. So overall, much stronger report than anticipated, so that's good. CPI beat on every metric and futures unchanged. Well, we did see a spike here pre-market, and a very nice NASDAQ move up close to almost 1% in the green, and S&P also up over 70 basis points. So again, calls are going to print for folks that were betting to the upside, and volatility here dropping almost 4%. So just over 12 at the moment. Now, if there's any stocks, any companies you want me to go over, I'm happy to go over those stocks for you. So what stocks would you like me to analyze? Let's see. I've never done this Q&A type question stuff. So I don't even know how this works. Yeah, so we'll see how that works here. But Enphase, yes, Enphase also pushing higher 5%. So the good thing is that Enphase is coming up to its resistance. So 4% in the green, 137.79 is where it's at pre-market. So 138 is a very strong resistance here for Enphase. and that is where the focus is going to be, whether it breaks out above its double top resistance or not. And before we start going over individual stocks here, do me a favor. We've got over 500 people watching. The only thing that I'm asking in return is that you drop a like. I'll go over as many stocks as possible for all of you. So I see a lot of stocks that you guys are writing in the chat. I'm going to go over, spend a couple minutes on almost every single one of them. All I'm asking in return is that you drop a like and subscribe to the channel if you haven't already. That's it. That's all I'm asking. If you want me to go over your stock, I'm happy to. Just please make sure that you drop a like. And of course, subscribe to the channel as well if you haven't already. So we're at about 120 likes here with over 500 people watching. So we can easily get up to over 400 likes here in this live stream. So I can go over every single one of the stocks here that you guys are talking about. So end phase, getting that out of the way. So 138, triple top resistance needs to break out above this level in order for us to see 151. But in my opinion, I do believe that after the market opens, we do see a little bit of rejection here for end phase at that 138 level once again. So it's possible that we do see a gap up and then a red candle on a green day, suggesting for intraday price action that's coming down, right? So with some selling pressure here. So that's possible. Keep that in mind. But coming up to that resistance at 138, so that's actually very good. Tesla has been weak. Tesla has been very weak. So I'll be honest, I'm not super confident with Tesla at the moment. So it's possible that Tesla continues to see some weakness. Of course, tomorrow's vote is going to be very, very important. So depending on which side we're leaning to with the vote, of course, Tesla's price action is going to be dictated by that vote here, by that verdict. But a huge area of supply and resistance, roughly at 188 to as much as $211, and a massive area of support and demand in the 150s for Tesla. And right now, it's just been consolidating sideways, but it does look weak. I'll be honest here, even though I like Tesla a lot, it does feel very weak from a price action standpoint. So going over to advanced micro devices, so AMD, a lot of people mentioned, so seeing a little bit of a bounce back higher from that 159, 160 level, so up over 1.5% on the back of this inflation report. Next resistance and target's going to stay put at close to $180 to $183. So that right there is going to be that level to keep in mind, and a much stronger area of support here in the 150s for AMD. AMD very similar to, I would say, well, maybe not NVIDIA, but it does trade at a bit of an expensive valuation here. So I'd be careful. I did trim. I think I exited all of AMD. Yep. So I did sell. I sent out an alert, I think last week or a couple of weeks ago here, getting out of AMD because I do think that the valuation's a bit too high. I do have a lot of SMH, so I don't mind holding on to the semiconductors on a more aggregate basis. But when it comes to individual stock, there's going to be more volatility, of course. Support level is going to stay put at 160, down in the 150s, 130s, all the way down to $118 for advanced micro devices. Okay, going over to SoFi and then ASO. SoFi here, consolidation sideways, still waiting to get going here. Very strong support inside this green rectangle in the 670 range. We've gotten bought up here in the past once, twice, 3 times, 4 times, really just consolidating sideways. And of course, if you do end up, let's say, breaking down below this, the next most stronger area of demand and support is going to be in the 450, 460s for SoFi as well. So those right there are going to be a couple levels to keep in mind for SoFi. Resistance all the way up to $8.25. 1 second here. Yeah, so that right there are going to be some support levels. So at close to $6.75 to as much as $7, and a resistance up to $8.24 for SoFi. Okay, going over to ASO, so Academy Sports and Outdoors. I think we've analyzed this company before. It's coming down to a very nice support here inside this green rectangle at $48, $49. So that's going to be that higher low, kind of aligned with this ascending support as well. A bit of an oversold RSI. Again, the price action's been pretty weak, down about 32, 33%. It actually does look pretty solid here at these levels, ASO. Very strong area of support, like I said, demand sitting roughly at $48, $49 with a massive target and resistance up to as much as $70 to as much as $75 for this company, right? So for ASO. Okay, next one on the list. We got lots of companies. Freddie, Powell rate cuts today. So most likely not. I don't think we're going to see rate cuts on the day today. But I think it's going to open some doors after today's inflation numbers. I think we're going to see, some expectations for potential rate cuts in 2024, at least 1, if not 2 or more. But again, SEP, Summary of Economic Projections, is going to lay out some of those numbers, later today. So at 2 p.m. Eastern, we're going to get the SEP, we're going to get the statement, and we're going to get the press conference as well. So Anarchy says, it's so strange seeing people celebrate these numbers as if inflation is not still insane compared to what it was just 5 years ago. Deflation should bring in celebration, not this. So yes, I mean, so the idea is that you really want to see inflation grow at a stable 2% rate, right? So even deflation is not good for the economy, right? So deflation is, in fact, I would argue, worse than inflation or significant price increases, because if there's inflation, right, like what we have seen before, like what we've seen over the last couple of years, if there's inflation, if there's prices increasing at a rapid rate of 4, 5, 6, 7%, then of course that means we're seeing a lot of pricing power. Consumers are still going to spend, right? They're still going to spend because they have to fund their lifestyle. So in other words, economic growth is still strong, right? Even if inflation is high, economic growth is still strong up until a certain point. But if there's deflation and prices keep going down, then of course earnings take a toll. If earnings take a toll, unemployment eventually rises. Unemployment rises, spending drops, and that's a really, really bad cycle that you don't want to be in. And at that point, of course, the Federal Reserve can step in to lower interest rates back down to 0% to spur more spending, more growth, and more investing and spending and whatnot, so earnings can go back up, and we can start stimulating the economy in that sense. But again, deflation is also not good for the economy. So what we really want to see is inflation over time kind of stabilize at around 2%. Some years, of course, it's going to be higher. Some years it's going to be lower. But on average, the Federal Reserve's target is 2% stable increases in prices for goods and services in a very healthy economy. And over the last year, we've seen prices go up by 3%. But yes, compared to 4 or 5 years ago, we've seen a significant increase, like 20, 30, 40% growth in overall prices. So yes, that is true. These numbers, even though, from a market standpoint, are worth celebrating, only because the year-over-year increase has been coming down. The bottom line is that yes, prices are still increasing. That's the bottom line, that they're up still from where they were 2 years ago, 5 years ago. Okay, time to analyze some of the more stocks here. So SMCI, Broadcom, let's take a look at those companies. So Super Micro, by the way, you can also analyze fundamentally Super Micro right now on our platform. Eventually, there's going to be a lot of other companies, of course. But right now, as it stands, you can see the revenue growth rate for Super Micro over the last 3 years is 28% on an annual basis. Very, very strong numbers. And if you take a look at the diluted earnings per share, right? So EPS growth for 3 year for SMCI, 92% every single year. So almost doubled earnings per share over a 3 year period. 5 year period, 67%, and 10 years over 37%. Free cash flows over a 5 year period have gone up over 60%. 10 years period over 53%. So this company has just seen a massive growth. And on a forward basis, so estimated forward, we've got over 111% for SMCI in terms of that growth here. So, if you come over to some of the MoneyVest metrics here, you'll notice absolutely rapid expansion for the overall margins. So gross profit margins increasing, to 18%. On average, 16%. So that's, again, very nice increase. Net margins also increasing to almost 9%, right? So if I just plot these two things, you'll start to see how quickly they have ramped up these margins here for the company, right? So very, very strong growth in gross margins, net margins, even operating margins have gone up significantly. Let's just go over to 5 years if we can. Let's see what the numbers look like. So again, you can see a very nice increase. Then EBITDA margins and then free cash flow margins also turning positive here for the company. Free cash flow, if you remove free cash flow here, just 1 second. There we go. So very nice growth here overall from the company. So, but again, if you look at the valuation, it is a little bit more on the expensive side. So you can see that it is expensive, trading at those multiples compared to the price to earnings, compared to the earnings growth expectations, because EPS expectations here for SMCI is still pretty high, because analysts are absolutely going crazy on these EPS expectations from $11.43 to as much as $43. So 4 times is going to be the increase in SMCI's earnings per share over the next 4 years. And revenue is expected to grow from $7.1 billion to over $24 billion, with a CAGR of about 19% on an annual basis for the company. That's most likely going to decline post 2027. So 2027, 32 billion, and then coming back down to around $20 billion. So that's going to be a decline of about 38% is what the analysts are expecting in 2028 or beyond. But again, analyst expectations are very, very high. These are the price targets for SMCI. $1,500 on a high basis, $1,000 on an average basis, low target of 287 with only one sell rating, 5 hold, 12 buys for this company at the moment. So again, very, very high expectations for SMCI. And again, the stock price, of course, is near all-time highs as well. Massive support sitting at $704, $705 for this company. Okay, next one on the list. Let's take a look. We got lots of companies, so I'll try to cover as many as possible. Yeah, AMDP is too high compared to NVIDIA, but that's for a reason. We've talked about that. Let's take a look at Zscaler. And Zscaler here, also pushing higher, coming up to that resistance at 193. So that's the level to keep in mind for Zscaler, and support level is going to step out at 166 for Zscaler as well. Down to as low as 142. Quick take on the markets here. QQQs are pretty up and stable, up about almost 1%. We got the S&P 500 up over 86 basis points as well. And of course, the Dow Jones also pushing higher, up over 82 basis points, with the 10-year treasuries sitting at just under 4.3% at the moment as well. So ACLS resistance is going to be 135, Alex, a vault. That's going to be 135, closer to 140 for XLS resistance here. So Rebecca, when they speak about lowering interest rates, is that pertaining to housing market? No. So they're talking about the federal funds rate, which is, the overnight lending rate between banks. But eventually that also does affect mortgage rates, because as the federal funds rate starts to come down, all the other interest rates, are either pegged by the federal funds rate or the 10-year treasuries. So eventually, yes, that will also start to roll over as the Federal Reserve decides to cut interest rates. So yes, eventually we can see mortgage rates also coming down. When will we see a good point to enter the market? Do you feel there's going to be a pullback? So, there's multiple different ways you can answer that question. By the way, PMM Production, thank you so much for that donation. I really appreciate it. Jeremy, I don't know when you sleep, but I appreciate your dedication. Thank you so much. Appreciate that. We'll take a look at the Fortinet as well in just a second. But, when it comes to just investing in the markets, really, there's a couple of things you have to understand is that if your time horizon is long enough, and if you want to be a little bit more passive, you want to have a more passive approach, then it really doesn't matter when you invest, like straight up. Like if you're investing for 5+ years, and you don't want to be actively involved, if you're just like, okay, I just want to buy and hold something, which is simple, an ETF or an index fund. I've tested this with VUG, and we've literally tried this with this ETF. I bought at the worst possible time back in 2022, I believe. That's when we started the experiment. So I remember buying this at the beginning of 2022, at the end of 2021, picked it up at 322, right? And dollar cost averaged my way in every single week, every single month, was buying at the top, at the bottoms, at the top, at the bottoms, just kept on buying. And eventually what happened was, of course, now up 25 to 30% on this ETF, as it has now hit a new all-time high. So if you've got a long enough time horizon and you want something more passive, you don't want to be actively involved, like looking at the screens all day, it really doesn't matter when you exactly buy an ETF, as long as your plan is to dollar cost average regularly over a course of time, right? So, but if you want to have a more active approach, understand, risk rewards, understand more individual stocks, actively get involved and kind of play around with your risk exposure, cash exposure. Right now, let's say, for example, I'm 20% cash. In the best scenarios, when the markets are offering very, very good deals, that number comes down to 4 to 6% cash, because I'm mostly long invested, 95, 96%. And that's when a more thorough analysis, where if you want to take trade ideas related to levered ETFs or individual stocks, then you can be more actively involved. And that's when the question becomes, okay, are the markets expensive right now? Are the markets technically overbought, overextended? So does it mean that I can kind of hold off a little bit on buying? So different ways, different time horizons, different risk tolerance, different ways you can invest. But those are some questions you need to ask yourself. How long am I investing for? Do I want a more passive or an active approach? What's really my strategy? Is it more ETF index funds geared, or is it more individual stock geared or swing trading geared? So again, strategy also very, very important. Okay. So Srinivas, PayPal is going to be a dead investment, as a lot of competition in that space. So yeah, I mean, eventually the numbers should tell us the whole story. So if if of course PayPal's numbers eventually start to dwindle, if they start to come down, or they start to not do well, then yes, we can make a case that competition is eating away on PayPal's market share, margins. But as long as the numbers stay steady and they're growing, they're holding well, I don't see how PayPal's moat is compromised until the numbers are not suggesting that, right? Everything that we talk about eventually translates over to the numbers, right? Everything. Whether it's a story about a specific stock, a technology, a potential market opportunity, whatever the case might be, everything is eventually going to be represented in the numbers. So Walter, time in the markets only works for ETFs, not for stocks. I'm still down 60% on most stocks I bought during COVID when I didn't know how to trade, buy and sell. Exactly. So we've talked about this, right? This long sage that you buy and hold forever, right? You buy and hold and never sell. That is only true for ETFs and index funds, but for individual stocks, I've mentioned this before, that the story is constantly changing. The story is constantly changing, right? So you want to be very much alert and aware of when that story changes. And of course, when we're starting to see the shift in, let's say, whether it's the management or the product or the customers or the strategy or whatever it is, right? Eventually, so what happens is there's a qualitative change that happens first, and then eventually that translates into a quantitative change. But the fact of the matter is that it's much more difficult to pick up on the qualitative change than it is to pick up on a quantitative change. So I'll give you an example. If Tesla, for example, if there's a material change in the qualitative analysis, maybe their brand is not good enough anymore, maybe the management is not efficient anymore, maybe they're going through some things, they're going through cost of operations going up, something more qualitative that's happening within the company that investors may not be able to see right away, and that takes a couple quarters to show up in the numbers, right? Numbers is going to be the quantitative analysis. We're going to eventually see that, okay, why are the margins going down? Why is the cost going up? Why is this happening? Why is that happening? Why are the numbers like this now? So you can kind of tie it back to, okay, 2 quarters ago, 3 quarters ago, this happened, that happened on a more qualitative basis. So that is more difficult to pick up. And same thing is true when the companies are doing better. They're getting better. Eventually, early on when Meta was obviously focused on artificial intelligence and the metaverse and whatnot, all people saw was numbers getting worse and worse, right? Huge capex, huge spending. But eventually the numbers became better and better, right? So people who bought just on the basis of that qualitative improvement obviously benefited from that early investment when eventually the numbers got better and better on the back of everything they were working on, right? Artificial intelligence, algorithms, their feed, stories, reels, everything eventually got to a point where numbers also started showing progress and gotten better over time. So that's why it's so important to be on your toes when it comes to individual stocks, because no company is ever immune to all market environments. As I've mentioned before, any stock, any company can be disrupted like that, especially when you're working with so much, technology, so much digitalization, like in all areas, especially with AI now. Any company can be disrupted overnight. Doesn't matter how strong the moat is, how strong it's been doing in the past. So that's why it's important to, look at companies that have a very strong moat. Market penetration is very, very restricted. I think Nvidia is one of those companies that's doing something that no other company can really do at that size and scale. Apple is a good example. Amazon is a good example. Even Tesla to some extent is a good example, but it's got a lot of competition in that space. So its moat maybe sort of compressing a little bit over time because there's a lot of competition in electric vehicles and auto manufacturing. So Thomas, ARK just released their 2029 price target, expected $2,600 per share. Do you think it's way too ambitious? 2029, that's like 5 years out, and they're expecting Tesla to be $2,600 per share. I'll do a video on those expectations here. But yeah, that seems like way too crazy. ARK just being ARK, nothing new from them. Even Nvidia probably will have a big correction. It could be after it first goes to 150 or 160, even 200, but when it corrects, it will go down 30-40%. Would you agree? It has happened before. Yeah, so, every company is going to go through cycles. No company is ever immune to all market dynamics here. And eventually we're going to see the pendulum swing to the other side as well. So Raytheon, very strong uptrend, defensive stock, right? So higher highs and higher lows here. We'll keep a close eye on a support. If you are investing this stock, keep a close eye on a support here, sitting roughly in the $104 to $105 range for this stock, for this company. So that's going to be a level to watch. But yeah, very, very strong move to the upside from October of 23. This stock is up nice 59, almost 60%. Enphase mooning, so that's great. Up almost 5%, so 139. We're already starting to see a breakout above this level. And why? Why do you think Enphase is starting to see a very strong move to the upside? Why do you think we're seeing such a massive move for Enphase and probably for a lot of for a lot of renewable energy stocks here? Earnings disclosure, 51 cents, 65% decrease from same quarter last year. Rate cuts, yes, none, absolutely. So rate cut expectations, right? So a lot of renewable energy companies are very much dependent on rate cuts because demand right now is not strong, or at least it hasn't been strong as rates have gone up, because it's far more difficult, more challenging for people to finance solar panels, micro inverters, redo their entire home, install solar panels and all that stuff. So as interest rate expectations come down, meaning there's going to be potential for more rate cuts, it's possible that that we do see renewable energy solar stocks to also go higher, as we are seeing today. So SolarEdge up 5.6, First Solar is up over 2.7, and Enphase up over 5% to 139.25. Very strong move to the upside for Enphase as well. So thank you so much for joining, everyone. I really appreciate that. We're going to do another live stream later today to go over the FOMC press conference, the speech. In the meantime, I will be going over a couple updates to go over the recent inflation report and some other updates on Tesla, Enphase, Nvidia. We'll cover those stocks individually in a more dedicated video. So overall, inflation numbers coming in very, very good, very positive. So, beats on across all four metrics here. And let's just quickly take a look at the market's expectations now for interest rates. Come over to probability. And now look at that. Look at that. 1, 2, 3. We're back to 3 rate cuts in 2024. That's what the markets are pricing in now. First rate cut in September. Second rate cut in December. 1, 2. Yeah, so first rate cut actually in September. Second rate cut in December. No, actually still 2 rate cuts right now priced in. 1, 2. Yeah, and the third rate cut is actually in January now. Okay, so January of 25. So that's where we are with the rate cut expectations. Originally, it was September, December, and April. And now we are September, December, and January. So very quick rate cuts in December and then in January is what the market's pricing in. So thank you so much for joining, everyone. Really appreciate it. Make sure that you drop a like, subscribe to the channel. Also, don't forget, we've got our MoneyVest beta launch happening on July 8th. So you can right now get a 51% discount if you want to lock this pricing in forever. You'll have access to this entire platform where you can analyze individual stocks, do a full fundamental analysis, including our MoneyVest metrics, including our detailed analysis for analyst estimates, balance sheet, cash flow, ratios, insider transactions, ownership, calculate your own intrinsic values, fair values, and price targets on the platform as well. So link's going to be down below if you want to join. Of course, lock this pricing in. We're going to be adding more features, more tools, more additions to the platform in the future as time goes on, and that's going to be done for you at no additional cost. So link's going to be down below. We'd love to have you on board. If you have any questions, feel free to let me know, and we are ready for market open here in just about 15-20 minutes. So thank you so much. Happy investing, and I'll